Thanks, Kim, and oh, okay.
Oh, yeah, everybody stop and hit the button.
Yeah, I see. Thanks for having me. So let me jump straight into it. So basically, I'm interested in how do capital and goods market integration interact, and the motivation is the following. Emerging economies typically open up to trade since the 1990s, followed two paths. The first one was that they also, at the same time, usually, also opened up to indirect capital inflows. This was typical in the 1990s. But more common, and especially recently, this is the more common one, is that when they open up to trade, like China and India, they keep their capital markets closed. And integrating capital markets, what's the rationale for that? The advantage is that there is higher growth and faster adjustment to the trade shock or any type of shock that the economy gets. But as it has been documented, it comes at the expense of misallocation and, of course, loss of financial sovereignty, so monetary policy might be affected. So the policy consensus right now is to relatively postpone or do not even allow indirect capital inflows. So I want to highlight that this is about indirect capital inflows, not about FDI. Everyone loves FDI, but indirect capital inflows usually can generate misallocation. So what I'm after here is that I'm going to study an economy that is opening up to trade with either open or with closed capital markets. I'm going to focus on a particular integration episode, that of Eastern Europe to the rest of the European Union in the 1990s. For that, I'm going to build a general equilibrium trade model with firm dynamics and financial frictions. The main quantitative exercise, I'm going to open up the trade from the 1990s level of trade. And at the same time, do the following experiment, either open up capital markets or keep it closed, and also investigate the transition path. It's going to be a horse race between having cheap capital versus misallocation. And what I'm particularly interested in is comparing welfare consequences and productivity, aggregate productivity of these economies. And the result can be summarized in one sentence. Cheaper capital is almost universally going to dominate the adverse effect on productivity. So this exercise is calibrated to Eastern Europe, where we have a 20% import share change in value-added terms. And the capital market integration in these economies are going to magnify both the gains and from losses from trade. So there's going to be higher output gains from integrating capital markets, up to 27% from 16% when you only rely on your own capital market, and also higher consumption gains. But at the same time, the economy will suffer more misallocation, higher inequality, and lower aggregate productivity. But with all that, all these are going to be second order, and there is going to be much higher welfare if you integrate capital markets. But the real difference is going to come along the transition path. So if you take into transition path in these dynamic economies that tend to decrease the gains from trade, but welfare gains from trade are going to only decrease for the case when you rely on your own capital market. If you allow for capital inflows, then welfare gains are going to be much higher, so it's actually going to reach the steady state level of gains. But there's going to be a lot of things going on at the same time. And I have two additional results. The first one is that without trade liberalization, if you only do capital market integration, that's going to benefit you much less than if you also open up the trade. And also I do the exercise of changing development, financial development in these economies. And what I find is not really a strong result. What I find is that more developed economies are somewhat less affected by both reforms, but the effect of trade liberalization, so the interaction between trade liberalization and financial development is very weak.
So Laszlo, can I ask you, when you say like more misallocation relative to what? When we talk about misallocation, what should I be thinking about?
In this point, relative to the economy where you rely on your own capital markets. So you keep capital markets closed.
But just in
Why-
general, the
why is this worse?
misallocation, so what's, I'm sorry, I just don't, maybe I'm not on top of this yet.
Sure.
Where's the misallocation coming from when capital markets are, it says when capital markets are integrated, we're getting misallocation, is that right?
So there is always misallocation in this economy
Okay,
because of, I'm going because basically of a borrowing constraint, but it's going to be higher if you allow for capital inflows. That's the point.
But why? I guess I had the same question.
Oh, yeah. That's going to be the explanation part. Basically, there are going to be two effects. First, there's going to be a shift in using capital. And because misallocation here is generated by financial frictions, so a borrowing constraint, basically, firms that have higher wealth are going to be able to use more capital, not necessarily the firms that have higher productivity.
So let me ask you a question, because each firm, maybe there's entry or not, but abstracting from that, each firm without capital markets opening up will have its access to the labor and capital markets.
Yes, exactly.
And some borrowing constraint.
And there is misallocation even in that economy.
Right,
Even if you keep
because of a
capital markets.
borrowing constraint.
Exactly.
And then when you open up to capital markets, you're either going to decrease the price of capital or
Yes.
Relax the borrowing constraint, and maybe both. So
No,
you're
it's not-
putting in, I guess what I'm a little puzzled is, in the model that I have in my mind, maybe it's different, you're going to increase the factors of production potentially to all firms, because all firms now have cheaper capital markets. And so the question is, in a relaxed borrowing constraint, the question is, why would misallocation ever worsen the total output?
Okay, so you are asking if why is aggregate productivity decreasing? I guess that's the question. Is that?
So aggregate productivity,
So output can still go up.
You have more factors of production.
Yes.
And I guess, how would that ever give you lower output?
Lower output is almost impossible, but you can have lower aggregate productivity. I agree with that.
Right, great. Okay,
Sure.
so now I kind of understand.
Okay. Are there any questions? Yeah, please feel free to intervene. Okay, so the outline is that I'm first going to present the empirical motivation, then going to talk about the model, the ingredients, and the mechanism, and then show you the quantitative analysis. So I'm sure you're all familiar with how trade liberalization in Europe happened since 1992, but basically we've seen a large increase in mostly intra-European trade after 1992, which also affected non-EU countries. So even Eastern Europe at the time was outside the EU up until 2008. And basically since then, trade has been not growing as much as before. And apart from other EU members at the time, Eastern European countries were not inside the EU, so they had the choice of how they are going to integrate their markets. Trade wasn't really a discussion. They opened up to trade relatively early, following 1992. But their capital markets, there was a large variance in how they opened up. And I'm going to focus on one country in particular, Hungary, that mostly allowed foreign credit to non-financial corporations after 2001. So there were various restrictions, and it's pretty difficult to distinguish which restriction was important. The last one was shifted after 2001 about converting capital, but it seems like that one had the largest effect on foreign credit to non-financial corporations. And during this same time, EU countries experienced a rise in misallocation measures of capital and not in terms of labor. So it seems like, and this is again, could be mismeasurement, as the misallocation measures seem to increase everywhere. But if there is a resource that was misallocated during this time due to trade or capital market integration, that was probably capital and not labor. although labor market frictions are much higher in the EU. Okay, so here I'm showing you the foreign credit to non-financial corporations as a fraction of GDP. So I basically, because of a lot of state-owned companies, I have to normalize to the 1987 level. And as you can see, after 2001, there is an explosion in foreign credit to non-financial corporations. So it seems like during that time, there was indeed a capital inflow, and it happened relatively quickly up until 2008. So again, a lot of with capital market integration or financial integration rather in Hungary, households were affected. I'm all abstracting for that because in my model, I'm also going to focus on almost only corporations. And the second point is that I want to show you is that during this time, as you can see, the dispersion measure, so the dispersion of average revenue product of capital has increased in Hungary in particular, although it was also increasing in many other countries at the same time. Interestingly, Romania, that only entered the EU much later, I think 2009, only seen an increase in these dispersion measures afterwards. And at the same time, if anything, labor market dispersion, on the y-axis you see the dispersion of labor market, of average revenue product of labor, you've seen that there is actually a decline usually in these measures. So if there was something going on, it must have been on the capital markets. So next, I focus on the microdata to motivate the model ingredients and mechanisms that I have. And in particular, I'm interested how exporters use finance, and then do we have any interesting dynamics there? For this, I'm using Hungarian administrative financial statement firm level data starting from 2001 and 2017. But I actually have multiple versions of this data from different sources. So sometimes I'm going to mention the differences. And I'm going to focus on the 2008 cohort that is alive in 2008. And basically in my calibration, I'm going to treat this cohort as what would my model predict for after opening up to both trade and capital markets. And because I only have revenue product data, so I do not have prices or quantities, I'm forced to use a particular measure for, let's say, productivity. That is, I'm going to focus on this category, zombie firms. This has it has one definition, that these firms are those that do not have positive pre-tax profits for 3 consecutive years. This is useful because I have a very similar group and I can construct this group in the model as well. So I can compare those. And I, of course, I won't have time, but I have some more formal reduced form analysis for these data sets. Okay, so what I see in the data in this graph, I show you on the on the x-axis, I have different deciles of value-added capital and capital labor ratio. And on the y-axis, you see the fraction of these deciles that are exporters. So as you can see, those firms that have the lowest, that are in the lowest value-added and capital labor ratio, tend to have the lowest probability of exporters. Sorry, that's not true for value-added, but for capital and capital labor ratio. As we increase, so as the firms are getting more capital or capital labor ratio, more of them tend to be exporters. Okay, so what I wanted to say here is that exporters are not necessarily the largest firms, as there are quite a bit of variation, but they tend to be the more capital intensive and they tend to use a lot of capital. The second point is that this definition of productivity that I want to use, the fraction of the zombie firms in each of these deciles tend to actually decrease. So the more value added a firm creates, the more capital they have, the higher capital labor ratio. And also, I don't have it here, but if they employ more workers, they tend to be less and less zombies. Overall, this percent is not high, so roughly around, even in the lowest bracket, 4% of the firms are zombies. So, these firms, they make losses, but at least they do not take up a lot of resources. They do not use up a lot of capital.
Sorry, what's on the x-axis here?
Yeah, x-axis different deciles. So
Okay.
the one means that those that generate that are less than 10% of in terms of value added.
Okay, so they're value-added deciles.
Yeah, value added deciles and capital deciles and so on.
And so
Is that
Laszlo, you're
Yeah.
calling these guys zombie firms. So I'm used to the idea that like the Japanese zombie banks and stuff were sort of not profitable banks, but were being propped up by the government. Is that going to be the same story here? You're thinking of these firms as being not profitable, but the government is keeping them alive or something like
So
that?
not the government, but basically the institution here in the model is going to be the borrowing constraint, and because of that they can be more capital intensive, and that's why they are staying alive. Well, this is just that they could stay alive, right? They become more capital intensive relative to firms that do not have access to as much capital. The reason, the thing that's going to be different in the model that only happens if these reforms are implemented is that they actually want to stay alive. Okay, there's going to be a difference, but I'm going to talk about that in a moment.
Okay, I'll wait for it. Yeah.
So the problem is that once I look at the fraction of export, so now I only look at zombie firms. There's not a lot of them here, a couple of thousand still. But what I see is that among the exporters that use up a lot of, among the zombie firms that do use up a lot of value-added capital or have high capital labor ratio, exporters tend to be overrepresented. So this costly group for the economy in terms of misallocation, or those who use up a lot of resources and still they make zero profits, tend to be these large firms. Okay, so it seems like that there is some connection between exporting and being a zombie for this costly group, and that's precisely what my model is going to predict. That there are some firms that only want to stay here because they are exporters. They don't want to forego their costly export status. Okay, that's how I want you to think about this.
Should I be at all concerned that these firms are reporting themselves to be zombies as a way to not pay income profits taxes?
Oh, sure. So Hungary luckily has one of the lowest corporate taxes.
Yeah, it has no corporate taxes.
No, it does have, but it's extremely low. So it's one of the lowest. I think usually when people talk about how to evade taxes, they combine Hungary with Switzerland and so on. So there's some name for it, but a Swiss cheese with I have no idea. Okay, but anyway, that's a concern. But I think that would be a concern even for this graph, right? For all the zombies. Why is it specific?
No, absolutely. Using the zombies as a measure of misallocation would be problematic if these firms are really being just effective and efficient in the way of reporting their profits and effectively profitable. But
yeah. So you are right
that Hungary is a fiscal haven.
Yeah, it is a bit, but I think what's important is that sure, in the model I can do better. Unfortunately, with the data, I don't have price data, so I cannot recover the true productivity. Okay, so let me talk about now the model. What are the ingredients? So there are going to be two countries, home and foreign. It's going to be a discrete time incomplete markets economy. Households are going to be heterogeneous with respect to their wealth, their productivity, and their occupation. They face a dynamic occupation choice. They can become workers, domestic producers, or exporters. They each are endowed with idiosyncratic autoregressive productivity. And if they decide to enter the export sector, they also have to pay an entry cost. And for every good that they export, they also have to pay a variable export cost. Okay. In the trade liberalization, I'm going to vary this variable export cost, and I'm not going to touch the entry cost to the exporting. There are going to be 4 different markets. The labor market is going to be centralized at the national level. Simply, those who start a firm are going to employ workers for their production. There is going to be a capital market that is going to be centralized either at the national level or at the international level, but there is one friction here, is that borrowing is only up to a fraction of their capital stock. Each of these producers are going to produce an intermediate good that is unique, with a unique variety, and they are going to be assembled into a final good by a final good producer in each of the countries. So households are going to be infinitely lived with log utility and discount factor beta. They are going to save in either a risk-free asset B or in a capital stock, which cannot be below 0. They face an entrepreneurial productivity that is stochastic, changes with each period according to a log normal distribution. And households face an occupational choice every period. They can earn either the labor income that is not proportional to their productivity, or they can become entrepreneurs, in which case they either earn domestic profits that is conditional on their capital stock, or exporting profits, in which case, of course, capital stock and productivity matters too. If they start their own firm, they pay entry costs, and in the calibration, I actually only have entry costs to the exporting firms. Financial friction, so what generates misallocation in this economy is that household debt is going to be subject to a leverage constraint that cannot be higher than a fraction of the value of your capital stock, because there are two countries. The price level of one country can be normalized, but not the other. And this theta is going to be a key parameter. If you increase theta, then that will generate a better allocation. Simply, entrepreneurs can jump to their optimal capital stock easier, basically in one period. And I'm going to make an assumption in order to simplify the state space. I'm going to assume that once the productivity shock hits, you are allowed to reallocate between your bonds and your capital stock. So basically, I only have to keep track of your wealth as a dynamic state variable and your occupation. Exporters are going to use capital and labor to produce their unique variety, and they are going to sell to final good producers, both at home or domestically. Both domestically and abroad. And they are going to face monopolistic competition with a constant markup that is the same across the two countries. For 1 unit of export to arrive, they have to produce 1 plus tau, because tau melts away during transit. And in this economy, there is going to be an optimal. So if you fix prices and quantity or aggregate quantities, there's going to be an optimal level of capital stock, absent financial frictions. Okay, that is conditional on your productivity. That matters for your marginal cost. The final good producer is going to buy varieties from domestic producers, both from importers and exporters, and they are also going to import varieties, and they are going to do so competitively. So there's a, yeah. So I'm not going to describe the equilibrium exactly. I have it here, but it's long, and I only want to focus on one market clearing condition: the international capital markets. So just as I said, this is about indirect financial flows. So closed capital market is going to mean that the deposits must clear at the national level. And the integrated banking system will mean that the bonds market has to clear at the international level. Okay, so you cannot start your own variety abroad. That's forbidden. That would be FDI. Okay, so how this misallocation will behave for exporters is key. The easier part to understand is the intensive margin. Basically, we will have suboptimal capital choice for the more productive exporters. And this is a key figure here. This is basically the state space, where on the x-axis you see the productivity of entrepreneurs, on the y-axis you see the wealth of entrepreneurs. And I'm plotting how far away you are from your optimal capital choice. And as you can see, if you are extremely wealthy, so you are in the top left corner. Can you see my mouse? I hope you can. So if you are in the top left corner of the state space, you are extremely wealthy with very low productivity. Then you achieve your unconstrained capital. But if you are very productive, you want to use a lot of capital in your optimal choice to begin with, but your wealth is relatively low, so you're in the bottom right corner of the state space, then you are going to be constrained. And hence, this environment yields this upward, more productive firms are going to be the ones more constrained because they are the ones that can use capital in the first place.
So Laszlo, this is like a picture in the steady state or something like that?
Yes,
what is
exactly.
Okay.
So this is the initial steady state. This is for illustration, although this is coming from actually the initial steady state. And the other source of misallocation is coming from the dynamic choice. And although at the entry margin, there's not much going on, you only want to enter and become an exporter if you are extremely productive. And basically, if you are not an exporter as of yet, then you are also probably going to be poor because this is the only way in general equilibrium to save your way out of poverty, you have to become an exporter. Okay, so it's easier to understand why this dynamic choice gives you misallocation by showing you the exit choice of incumbent exporters, because it depends on assets, and that's a clear, deviation from, let's say, from the Malitz model. So what I'm showing you here is the exit decision of incumbent exporters. If you have even the highest productivity, but regardless of your productivity, if you do not have enough wealth, you cannot achieve scale of production, so you cannot enter. As you can see, you would exit even here. But what's interesting is that conditional on your productivity, having a higher wealth actually helps, and you are going to stay an exporter for longer. Okay, so as you can see, this slope of the exit choice is the deviation, and is the dynamic misallocation in this model. Okay, so I hope this is the key mechanism in the model. So the way I calibrate it, are there any questions, or is this clear, Anna? Okay. All right. So the way I calibrate the model is that because I mostly have good data from 2008, I'm actually going to go on and calibrate the final steady state after both trade liberalization and capital market integration happened. And we are still not in the crisis year. So crisis started a little bit later in Hungary. These balance sheet data should not be affected by much. And for financial development, there are two key parameters that govern how much credit is in the economy. So there's the borrowing tightness. This is very simple to understand, that if you have a higher borrowing tightness, then the total credit is going to increase. But what's also important is that the discount factor and the difference between the discount factor between the foreign economy and the home economy is going to generate a capital inflow or outflow from the two countries. So for example, if foreign borrowing tightness is higher than the home and the two discount factors are the same, then actually we would have a capital outflow from Hungary, which is not what we observe in the data. So it's crucial that we also have to decrease the discount factor of the home country. And as you can see, total credit to non-financials, I'm matching the BIS data, and I also around half of the total credit is actually owned by foreigners in this economy, and both in the data as well. For trade, I try to target both the 1991 trade level in the initial import cost. So this is basically the only parameter where I target the 1991 trade level, or parameter data, sorry. And I also target the 2008 trade level import to GDP ratio. These are all converted to value-added terms using the OECD database. The final point is about firm dynamics, that, of course, if we wouldn't have matched if I wouldn't have matched the firm dynamics, misallocation could be a much bigger issue. So it's really key to match both the value added and the autocorrelation of the value added in the data. And there is one parameter here, the export entry cost, that is key. So as you can see, I'm matching the entry rate to exports simply because there are multiple data sets that I use, and they differ in this variable the least. If I would target the more natural, I would say that was my first attempt. If you target the exporter share, the share of exporters in the economy, then this would yield different numbers. But I'm going to show you that as well. So the non-targeted moments, as you can see, as any models of financial frictions, I can only explain around half of the standard deviation in the average revenue products of capital. But I do a relatively good job in capturing the dispersion in the log capital growth in the data. And as I said, depending on the data set, the fraction of firms that actually export, depending on the cleaning and so on, differs a lot, from anything between 2% to 38%, but they do not differ on the entry rate. Oh, sorry, I skipped this one. Yeah, so I have a bunch of pre-assigned parameters. I think the only important one is that the foreign economy is roughly 4 times larger. So I focus on the economy of Eastern Europe versus Western Europe. Population-wise, that yields roughly around 6 times larger Western Europe than Eastern Europe. For financial variables, the one I want to mention is the zombie exporters. So what is a zombie exporter in my model? In my model, I say that an exporter is zombie. Of course, no one is making losses, but their outside cash flow option of becoming a worker is there. So if their profits are actually lower than what they would earn, would they become workers, then I call them a zombie exporter. It's also because, as I think Anna mentioned it, that you can just employ yourself in the data, right? For the firm, make losses and not pay taxes. So I thought that this is the appropriate measure, combining with the outside option.
So Laszlo, just to be clear, a zombie firm has a positive value, it's just not earning profits today. That's what a zombie firm is?
In the data, yes. In the model.
No, in the model. What is in the model?
So in the model, all firms earn profits. So
how do you, sorry, then I don't know. What's the definition of a zombie in the model?
Yeah, exactly. So a zombie in a model is a firm that is making less profits than their outside option of becoming a worker.
But they're
so they always compare
something like that. What's the they're acting optimally, right?
Yes, they are acting optimally. So why do they want to stay on workers?
Yeah.
It's because of the entry. Sorry, why don't they want to switch to become a worker? It's because they pay entry costs and they really do not want to pay it again. So if you look at this in my calibration, the entry cost to the exporting is 450 times the annual wage that you can earn nominally. Okay.
Yeah, so their net present value is still big enough that they don't want to leave.
Yeah.
There's no there's no outside
exactly.
force that's propping them up. They're acting okay.
Yeah.
Okay, I got it.
They are acting optimally. Yes.
Okay.
Right.
Yeah, so just to complete the issue is you have sunk costs, but you don't have a fixed cost. So without a fixed cost, everyone's going to make positive profits per period.
Oh yeah. I don't have fixed costs. I
Exactly.
actually implemented it, but it doesn't change much. It only shifts your value. Yeah.
No, it's fine. It's just a clarification of why it is that firms always have positive profits.
Yeah, and actually this is why I don't have entry costs to a domestic firm. So domestic firms never become zombies. But I also keep, sorry, so I forgot to mention that even with this, I do keep for 3 consecutive years, that's relatively easy to calculate in the model with transition matrices. You have to be, actually, you would, looking only at the cash flow, you would want to become a worker for 3 consecutive years. Okay. Okay, and finally, for inequality, I have wealth data, income data, both from 1991. So then I compared the steady state without any integration and the final steady states. And as you can see, actually, I overestimate the wealth inequality in the data, although that's 2014, so that's not entirely correct. And the income data, especially the 1%, I match relatively less, but it's still doing quite kind of a fine job. For consumption, unfortunately, I didn't find any data. Okay, so this is the main experiment that I do. That from the initial steady state, again, just a reminder, this was not the one that I calibrated completely. It was actually the final column. But from the initial steady state, I'm always going to compare what happens if I open up the trade. As you can see, this is corresponding to a 20% import to GDP change. That yields a roughly 9% increase in aggregate productivity. And actually, the dispersion in the economy of average revenue product of capital does not increase or massively. There's only a small increase. Sometimes I actually got that it lowered. But what was usually the case is that misallocation coming from financial frictions are not really affected by opening up the trade. Output increases, but because some of it is due that the home economy is much lower. So these are, I'm only showing you the home economy in these tables. Aggregate consumption goes up much less than either income or output. And capital actually decreases in this economy. And it can be due to several factors. I'm going to go into details for that. So what's in the alternative if we also open up the trade and capital markets? And then we see that aggregate productivity, so these are all again steady state results, aggregate productivity declines relative to when you only open up the trade. And some of it is because the dispersion measures so the standard deviation in average revenue product of capital increases massively. Nevertheless, it yields to much higher output, still somewhat similar income, but much more modest consumption gains. So there's only an increase of roughly around 0.5% consumption relative to the middle column. Okay.
Can you explain what the misallocation here is again?
Yeah. So basically, I'm going to go into details why misallocation changes the way it is, or is that the?
Yeah, that's my question.
Okay, yeah, that's precisely what I'm going to focus on.
Okay.
Next. But before I do that, I just want to show you that welfare increases as well for when you open up the trade, roughly the same amount as aggregate productivity. So if you only consider steady state to steady state. But if you take transition dynamics into account, then what you actually see is that if you rely on your own capital market, taking the transition dynamics into account lowers the gains from trade. And naturally, this should happen under both cases because it takes time for you to reach your optimal consumption level. But interestingly, and this is going to be the second part of my slides, this does not happen for when you also open up capital markets. Yeah, so let me jump to what drives the changes in misallocation. Yeah, sure.
So in the borrowing constraint, you have the price of the domestic final consumption good.
Yeah.
So that's because the debt is in foreign units, and that's like the
yes.
real estate.
Yeah, debt is in foreign units. It's always in foreign units, but capital is always in the local good. That's and just accounting, so that doesn't change. It doesn't change anything.
And what happens with that P, or you normalize the P? So
no. So 1P, yeah, this is what I call CPI.
Okay.
That changes as well.
That decreases. Okay.
Yeah, of course, with trade liberalization, the price level should decrease. It does almost the same as productivity, roughly the same. For actually, when you integrate both trade and capital markets, it decreases much less. That's why, even though there is more capital in the economy, with when you allow for capital inflow, real wages, nominal wages are higher, but real wages are actually going to be lower. Okay.
Thank you.
But good question. Yeah, and as you can see, overall, one of the reasons why credit to GDP is actually declining when you open up the trade is because, why capital is declining is because there are less savers in the economy, even though a lot of firms are going to start an exporting firm. You can see that the entrepreneurship rate, so initially around 21% of the population were engaging in entrepreneurial activity. That decreases to 20%, but there are a lot more exporters, so they use capital more intensively. But I'm going to go over this in detail. Exactly now, so what drives the changes in misallocation? Basically, the mechanism is that decreasing the cost of capital and trade at the same time, regardless of how we look at it, it's going to affect the potential profits of all entrepreneurs. It's going to increase it. There's going to be a direct effect with the variable trade cost, the decline in variable trade cost that leads to higher foreign sales. But what really matters is, again, the Malitz mechanism that I can decompose this change in these potential profits to this direct effect, which is relatively low. What really matters is, can you increase your choice of capital or your choice of labor or not? And what's different here is that for extremely productive firms, they cannot change their capital choice, or they can only change it by very little. Okay, so their profit increase from these terms are going to be lower. If they cannot employ a lot of capital, they also won't be able to employ as much labor. So although the direct effect, coming from that the foreign country is much richer, the direct effect is going to be greater for open capital markets, for exporters domestically. But the indirect effects are going to reward unproductive firms. Okay. So why is that? Again, I show you here in the state space of productivity and wealth. What I'm showing you, how much does your capital choice relative to your initial capital choice changes. Remember, these firms, if you are extremely productive, you want to use a lot more capital. So of course, a lower change, you still get to use a lot more capital. But it really favors those firms that are unproductive and high net worth exporters. They get to increase their capital stock by roughly around 250%. So this is the case when we open up to trade with open capital markets at the same time. Relative to firms that are very productive but have lower net wealth. They can only increase their capital stock by 50%. Whereas if you open up with closed capital markets, in principle, it could change completely, such that unproductive firms are not the ones better off. In this experiment, it seems that this is the case. Unproductive firms are still favored, but they only get to increase their capital stock by roughly around 18%, whereas productive firms can increase by 6%. So it's much more condensed. The differences are not going to be that huge across unproductive or productive firms. Whereas here, it's a 5 times difference in percentage terms. Is this effect kind of going in the right direction, hopefully? Yeah.
Sorry, somebody else was talking at the same time.
No, I think it was it.
Okay. So isn't there a melody? You've highlighted the effect of profits from exporting, of potentially exporting. But for firms that are far away from the export cutoff, isn't there an import competition effect that makes them want to invest less? And aren't those firms less capital, less productive? Is good. A very Malitz effect of selection.
Sure. So the domestic firms are
capital.
Sure. So the domestic firms are affected, and in fact, I think you're precisely right. If I go to domestic firms, actually misallocation for domestic firms, if you open up the trade, decreases. A lot of them are going to be forced out. You're right. I'm not showing that here. I'm only focusing on exporters. Okay, but you're perfectly right. For domestic firms, it's going to be they are going to be worse off even in this regime. They don't want to expand as much because capital is much more expensive. Right. So changes in capital choice affect changes in potential profits. It's condensed again relative to capital choice because there's also the choice of labor. But it is still true that the effect of capital is going to be that indirect effect changes the profits of unproductive exporters by roughly 100% relative to the initial old steady state. Whereas for extremely productive exporters, with open capital markets, they can only see an increase of 20% in their potential profits. So again, we are going to have a lot more firms potentially in this area of the state space, which is why misallocation is going to increase. If we open up with closed capital markets, potential profits are in between 13 and 7%. So potential profit differences are much lower here. But potential profits in turn, so this was about intensive margin, but potential profits also change, of course, your dynamic choice. So it's going to shift the exit decision from the initial area to the left in both cases, because all firms are better off becoming exporters. And as you can see, but the change is also shifting the slope of this exit choice. So previously, basically, if you were here, you exited, so you had relatively modest wealth and low productivity. Now you are not going to exit. And what's worse is that you have to actually get rid of more of your wealth. Remember, in this area of the state space, you are constantly making losses relatively. You're eating up more consumption, waiting for your shock to throw you into the better place in the state space. So you are going to have to lose more wealth until you exit with open capital markets. Okay. If you are with closed capital markets, it is still shifting to the left, the exit choice, but it's not as radical, and only a small proportion of the firms are affected.
Laszlo, this is your 10-minute warning.
Oh, okay. Yeah. Then let me go quickly to welfare. So basically, welfare, everyone prefers liberalized trade with closed capital markets, even though inequality is going to increase. Debtors are going to be the most productive low net worth agents, and they are going to be the ones preferring open capital markets. Domestic creditors actually going to prefer closed capital markets much more than debtors prefer open. And basically, the GE effect is going to be that workers with high net worth are going to disappear in the economy, and exporters benefit the most. So I wanted to show you this graph. Again, the same state space. Those with high wealth and low productivity are suffering from a 30% decline in their consumption equivalent welfare if they choose open capital markets relative to closed capital markets, whereas the group that benefits the most are much, much smaller in the state space. Okay, so the political economy of this reform, at least, is that the vast majority of people are not going to vote for such an integration of both capital markets and trade. And transition dynamics, this is the key. So basically, with the misallocation that I explained, I can show, hopefully you can understand what's going on with the transition dynamics. So one question I asked, are there short-term losses after integrating both capital and goods markets? And because most of the misallocation is coming from the inefficient exit, not in the entry, the answer is going to be no. Actually, there are going to be short-term benefits of these policies. because all the misallocation is going to come much, much later. And the second question is, what is the loss awaiting with the capital market integration? I find that that if you wait for 10 years, as Hungary did, there are very limited losses, around 1% of consumption equivalent welfare. To do this, I compare 3 paths. So in all the paths, I open up to trade in 4 years. The first path, I keep capital markets closed permanently. Second, the historical one, I only open up to capital markets in 10 years, but I announce this policy that I'm going to open up. So everyone knows that in advance. And in path 2, I open capital markets in the first year immediately. So as you can see, let's focus on total consumption. Path 1 was open capital, was red dashed line, means that you rely on your own capital markets. The growth in aggregate consumption is much lower, and it takes roughly around 15 years to reach the steady state. So it's a long time, which explains why the welfare gains are much lower. Whereas if you integrate immediately or after 10 years, what you see is that there is a large increase in consumption that gradually dies down. And the same is, it's because initially there are mostly productive exporters, they get the cheap capital, and it takes time for them to become unproductive and exit, or to increase misallocation and decrease aggregate productivity. Okay, and finally, with the historical, the green dotted line, if you announce this policy, what you will see is that exporters are going to wait for the cheap capital and roughly behave the same way because of the large entry cost. They are going to behave the same way as if the policy was implemented already. Okay, so aggregate consumption is going to be a little bit lower, but and then there's going to be more misallocation in the first 10 years, but eventually these exporters are going to behave the same way, whether the policy is implemented or not. Okay, and I have 5 more minutes, I think. So capital market integration, then I do the following experiment. Capital market integration alone has limited effect on the economy. So if I only integrate capital markets but do not open up to trade, what I find is that aggregate productivity gains or losses are much more dampened. So only 1% change. That can actually decline if the misallocation is higher. There are some transition dynamics gains, but even if you add capital and trade separately, the welfare gains, it's not going to reach 13%. So there is some advantage of implementing both trade and capital market integration. If you recalibrate the model, you increase the financial development, as in the foreign economy. First, the main difference between the economy is that all the output values are increasing massively, but aggregate productivity actually stays roughly the same, even decreases. And this is because a lot of firms are going to exit, so there's going to be much less variety in the economy. That's a more efficient thing to do. And if you then use this economy to study external reforms, so exactly as what I did before, you open up the trade, or you open up both trade and capital markets. What you see is that the trade welfare gains are roughly the same, even though the economy is much more developed. So it's a little bit lower, but it's still 5% if we round it down. But gains from capital market integration are actually disappearing. So there's only, in steady state, there's only 1%. And if you also take into transition dynamics, it's not 13% anymore, but only 7%. Okay. So I think I'm going to conclude, and I'm curious if you have questions. So what I did here is that I quantified the cost of maintaining closed capital markets after opening up the trade, focusing on sequencing of reforms. If you wait after trade liberalization to open up capital markets, that has a welfare cost, but in at least this setup, it's relatively low, modest, only 1% of consumption equivalent welfare. And the misallocation from capital market integration affects the economy through the increased survival of the zombie exporters. But it is in general going to be outweighed by the general benefit of having cheap capital available for all, especially short run. The two additional results: without trade liberalization, capital market integration is going to be less useful, and more developed economies are somewhat less affected by both type of reforms. All right, yeah, thank you. I think if I have 1 more minute, I rushed over these numbers. Yes, so I didn't have time at this point. But what I wanted to show you is that basically, no, sorry, this one. So if I categorize exporters into 4 categories based on their wealth and productivity in the model, if their wealth is higher than 2 times the national average, or if their productivity is higher than the national average, even of households that are actually not starting their entrepreneurial firm, what I see is that relative to the initial steady state, this group of high wealth but really low productivity, where you're better off just giving the firm to a random person in the population, from 4% of the exporters, it is increasing even when you open up the trade. But once you open up the trade and capital market, this group that is using up a lot of capital because they have high wealth, this group is going to make up 1/5 of the total exporters. Okay. All right. Thank you very much. Are there any questions?
All right, great. So yeah, now we'll open up for questions and continued discussion. Can I go first? Can we go back to the picture with the transition paths in it? I didn't quite, yeah, that one.
Yeah.
I don't quite get the productivity one. Can you walk me through that again?
Yes. So in the initial steady state, all firms, most of the exporters, as I showed you, are extremely productive because it's a very harsh condition there. So high trade costs, you don't want to be there if you are no longer productive, right? The exit choice is shifted to the right. So when there is free capital on impact or very cheap capital on impact, you just absorb the capital, and hence your borrowing constraint will also be shifted. You are going to use a lot more resources. So aggregate productivity is going to increase in the economy.
But that's just because, sorry, just if you think about like on impact, firms haven't changed any of their export decisions yet, but the exporters now are just get a lot bigger because they have more capital.
Yes.
Is that
so
what's
initially,
happening?
Yeah, exactly. So initially, you only see effects on the intensive margin. So everyone who is already an exporter is going to use up more resources.
Okay.
That's precisely right. So they are going to be larger. These tend to be the more productive firms. Hence, even though aggregate productivity is going to be lower in the long run than with closed capital markets, initially it's actually jumping.
Right, but so that's my next question. So then what then makes this thing go away? A bunch of inefficient firms start accumulating capital? Is that?
So if suppose you got a lot of capital at this point, initially you were lucky and you were an exporter, but after a while you are getting negative productivity shocks, right? Because it's an autoregressive process, but nevertheless you never exit here. It has to be really bad for a really long time personally for you to exit the export sector.
I see. So this is mean reversion basically happening.
Exactly.
Okay.
Exactly.
I have a couple of big picture comments, and then a smaller comment that I think is related to what Kim was asking, which is I was puzzled by the last table you showed that the wealth, low productivity guys are the ones that are becoming dominant in exporting when you open up to trade and capital, because those.
Sorry, which
the last table, the quartiles, the cut into 4 bins.
Yes, this one. Yeah.
I guess I missed it. I'm sure you said it, but I missed it when you said it. When you open up to capital, are you doing just a decrease in the price of capital, or decrease in the price of capital and the decrease in the relaxing of the borrowing constraint? Are you doing both? I guess my question is, I'm very puzzled by this result, because I'd expect the guys who were already wealthy to not be as affected by the capital liberalization as those that had the borrowing constraint, and now that borrowing constraint is relaxed, either because the price of capital went down or
Yeah.
because the borrowing constraint itself was
Yeah,
relaxed.
so the borrowing constraint, I do not touch the borrowing constraint, apart from the very last exercise, when I change the entire economy, I recalibrate the whole thing. So it's only a price of capital that is changing. So your borrowing constraint is the same. Suppose you are at the constraint.
Yeah, got it.
You are, okay.
Yeah. So then the question is, why are these guys who were unconstrained to begin with disproportionately affected relative to the guys that were constrained, and now they can effectively their constraint is going down because the constraint is on the value, right, of the capital, or is it in the quantity?
It is on the value of capital.
Yeah, so then their borrowing constraint was relaxed when the price went down.
Yeah. So
get more quantity.
of course.
So
For sure.
wouldn't those guys be more affected, the productive low wealth?
So their borrowing constraint is a little bit affected, but that's 5% because of only of the effect on the price level. So overall, they can only increase, right? So if you go to this decomposition, sorry. So if you can only increase, those guys can only increase their capital stock. Yeah, they can only increase their capital stock by the amount their borrowing constraint has moved, which is very little relative to those guys who were not constrained before. For them, the trade cost is going to be, the trade cost difference is going to be so large that their capital stock, they can and they will increase their capital stock by roughly 250%, which relative to to these guys who are constrained, they can still increase it by 50%, but it's not even comparable, right? Okay, so the effect on the borrowing constraint is much more limited.
So my other comments is that I had the two puzzles and the two things that I was a little confused about. One is, why not do this as small open economy? Why would you have a large economy that you have to put in general equilibrium and figure out what happens to the foreign country instead of just focusing on Hungary itself and doing a small open economy exercise? So that's
Okay.
one. The second comment is on the zombies. You said that you're exploiting the zombies instead of TFP just because you don't have price data. But for your context, I would think that revenue TFP is even more adequate than quantity TFP, which is not necessarily very meaningful in terms of profitability, as a measure of profitability of the firms. So there's a good paper that makes this point with the differentiated goods and these TFP measures by Laszlo, Verhoeven, De Rooks, and Franco, that that I think is fitting here, that the revenue TFP is what you want to look at, not quantity TFP. These goods are these firms are producing wildly different goods.
So I think for the first point, the difficulty is why I chose the two economies is because at the same time, I want to generate inflow of capital and also to have the foreign country to be more developed in a way. So I thought, and also having a realistic export demand function, so these three things have to be satisfied. And I thought it's a bit arbitrary if I fix the export demand and also generate the inflow, because the hypothetical economy that would be outside of these, right, could be even less developed if I would have to find it, right? And I was worried that, then I think I would be open to a criticism that, oh, but the rest of the world has to behave in a very weird way for this to generate this result. So I think I cannot do a small open economy without having weird assumptions about what's going on both at the capital market and the trade. The second point is, I thought a lot about whether a small open economy would work or not. The other point about TFPQ, yes. So what I wanted to say in the model as well, that I really need guys who are productive, so that I would see their productivity level Z in a way. That's kind of the point here, that I have firms in the model that have relatively low productivity, yet they are still exporters. And without the FPQA, I cannot identify these firms in the data. So I wanted to identify this group that is relatively well defined in both the model and the data. But and especially revenue product with misallocation, then, you know, if you have higher revenue product, that just might mean that you are more distorted and not more productive necessarily. So the two would be going the opposite way. Is that? I hope it's satisfying.
Yeah, it's clear. I'm not fully convinced I can hear your answer. That's okay. Yeah, so I could have one is, I think the link between TFPQ and Z in our models with firms with differentiated products is a weak one. And then you know, I could have a very good product and I'm selling at high prices and I'm selling quite a bit, and I have high TFPR and low TFPQ. And so what, right? A lot of the interpretation of these models is more of an output being a quality adjusted output. And so the revenue TFP would be more adequate. But there's a huge literature in sensitivity, and there's
I think part of the reason is,
and it's fine.
Yeah, I wanted to avoid getting bogged down on. That's why I, for example, only use average revenue product of capital and not go into productivity estimation, even revenue product. But yeah, I tried that too.
So Laszlo, you showed us pictures at the beginning about aggregate credit to firms, and maybe something about, I mean, I don't know if you showed us at the beginning or not, about, you know, capital inflows. Do you have that kind of stuff in your, do you have those stuff from your model? Like how big are capital inflows in your model when you open up? How big,
Oh,
how much is credit growing?
This figure, I match it exactly relative to the, so initially there are 0 foreign credit to non-financial corporations in my model.
Okay.
And then I match exactly the 2008 one, perfectly.
As part of the calibration, or as
it's
an
part
outcome
of
of
the
the model?
calibration.
That's part of, so part of the calibration is making sure
Part
you
of
get the same amount of. Okay.
Exactly.
Okay.
Okay. Thank you very much for the talk. Very interesting.
Thank you very much.
Bye.
All right. Bye. All right, Kim, I think we
Sounds
do
good.
you have any
Okay.
questions?
Yeah, well, let me stop the recording.